Hello everyone, my name is Michael Ruger. I am the managing partner of Greenbush Financial Group. Today we're going to be going over college savings options for children. Now there's a number of different types of accounts that you have available to save for your kids for college. The first being 529 accounts. There are Coverdell accounts, UTMA accounts, UGMA accounts, brokerage accounts, and savings accounts. So we're going to be reviewing each one of those today because some accounts have tax advantages, some accounts the parents have control over, others the kids have control over, and each of these types of accounts can have a different impact on your financial aid package that you receive when you apply for college. So I'm going to be going through these pros and cons analysis and giving each one kind of a grade today. I'll start with my favorite, which are the 529 college savings accounts. Now I give these accounts on an overall basis kind of an A grade because they have so many advantages associated with them. And one of them is tax advantages. Many states that have income tax, they will often offer a tax deduction for contributions to these accounts. Now it does vary from state to state, but like in our state, New York, for single filers, they can deduct up to $5,000. For married filing joint, up to $10,000 per tax return for contributions to these types of accounts. Now, these are state tax deductions, not federal deductions, but it's something. And the other really big advantage of these 529 accounts is the money accumulates tax-free and is withdrawn tax-free if used for college. So if I put $5,000 in one of these accounts when my child is 2 and it grows to, let's say, $20,000 by the time they go to college, when I take that money out to pay for college, I have no tax due on it, versus if I accumulate it in some other type of account like an UGMA or a brokerage account, I would have to pay tax on the full gain, which could be a big percentage of the account. Now let's talk about how these 529 accounts count against your financial aid. So since they're considered an asset of the parent, they are counted against the expected family contribution calculation, which kind of determines how much you have to pay out of pocket for college. However, it's a relatively small amount because the way it works is in an asset of the parent, for purposes of the FAFSA calculation, 5.6% of the account balance counts against your financial aid. So let's say you had $100,000 in one of these 529 accounts. Only about $5,600 of that account balance would count against your financial aid each year. So while it does impact it, it's not a really large amount. Switching gears over to contributions to 529 accounts, lots of flexibility here because there's no income limitations to who can contribute to these types of accounts, and also the annual contributions can be very large compared to other type of college savings accounts that we'll cover that have really low limitations as far as the amount that can be contributed in any given year. The second option we're going to cover are called Coverdell accounts, also known as educational savings accounts. These type of accounts carry some of the benefits associated with 529 accounts, but they have a number of limitations, which is why I kind of give them an overall B rating, if you will, in the college savings arena. So the major limitations to these Coverdell accounts is how much you can contribute to them, and also who is eligible to make contributions to these accounts. We'll first start off with the contribution limits in any given year, which is much lower than 529 accounts. So you can only contribute up to $2,000 per year per beneficiary to one of these accounts. You can no longer contribute to the account after the beneficiary turns age 18. The other major restriction with these accounts is they have income limitations that say who and who cannot contribute to these types of accounts. So in 2021, for a single filer, you have to be making under $110,000 in AGI to be eligible to contribute to one of these accounts. For a married filing joint, it's $220,000 or below, making you eligible. Once you're over those amounts, you're no longer eligible to contribute to these types of accounts for that tax year. The one advantage these accounts have over 529 accounts is they can be used for more than just college without any limitations. So these Coverdell accounts, they can be used for elementary school, if you kids go to private school, a religious school, so it can be used to pay for those things as well as college, where 529 accounts have limitations as to how much can be used each year for those amounts. Another difference with these accounts, Coverdells versus 529s, are Coverdells, the account has to be liquidated by the time the beneficiary turns age 30, where 529s, if there's money left over in those accounts, it does not carry this restriction. The third option are UGMA and UTMA accounts. Now, unfortunately, we see these accounts frequently, and overall, they get a grade from me of a D. And the reason why it's such a low rating is, number one is control. So once the child reaches age of majority, which varies depending on the state you live in, it could be 18, 19, or 21, they have full control over that account because now technically they are the owner, even though you might have put all the money into it. So if they decide instead of going to college, I'm going to go buy a Porsche, there's really nothing you can do about it. So because parents don't have control over that, it causes a big risk. The other big negative to these accounts are how they impact financial aid. So remember when we talked about 529 accounts, I said those were an asset of the parent and they're counted as an asset of the parent for purposes of financial aid. Well, these UGMA accounts and UTMA accounts are technically asset of the child and they're treated as such when they do the financial aid calculation, which is much more negative impact. So when it's an asset of the parent, they take the balance and they times it by 5.6%. When it's an asset of the child, it actually is weighed 20% of the balance against financial aid. So that same $100,000 balance in the college savings accounts, 529s that hurt you $5,600. If that was an UGMA or UTMA account, that $100,000 would hurt you $20,000 per year for financial aid. Lastly, these UGMA and UTMA accounts really have no tax benefit to them. There's no tax deductions for contributions. All the growth, when you actually go to liquidate it, is taxable to the child since they are technically the owner of the account. So not only no tax deduction, but all the growth you're gonna have to pay tax on. The fourth option is just to set up a plain vanilla brokerage account, which could really be used for anything. You could be using it for college savings, for retirement, for any number of things. So it offers you the most flexibility. Some parents that aren't sure whether their child's gonna go to college or not, this may make more sense because then you don't pay tax on the distributions if they're not used for college expenses. But there's also drawbacks because you as the parent owning the account, it's just an investment account. So you're gonna pay tax on all the gain, which if the parent's in a really high tax bracket, let's say 40%, you're losing 40% of the gain amount, which if that was in a 529 account, you wouldn't have lost it and you could have used that to pay for college. The other thing you gotta be careful of is if you're liquidating assets from brokerage accounts that have gained in value, it's gonna also increase your income for that year. So that could also hurt you if you qualify for any type of financial aid. We do have clients that use a blend strategy between 529 and brokerage accounts because they don't wanna overfund the 529s and put too much money in them. So a lot of clients will put the max amount they can in there to get the state tax deduction, whether that's $5,000 or $10,000 per year in New York State, and then the remaining amount they will put in a brokerage account saying, hey, I'm doing all I can in the 529 accounts to get the most tax benefits. The rest of it I'll put in this brokerage account. If I need it, it's set aside, but if I don't need it for college, then I can use it for retirement or some other financial goal. The final option is a traditional savings account. Now I give this an overall grade of a C. It's super safe, but because it's super safe, you might only be getting 1% or less in a return and interest from that account each year. So if I have a 2-year-old and this thing is gonna be working for 16 years and I'm only getting 1% per year, it really doesn't have the potential to grow by that much. So if the cost of college over the last 20 years has grown by 6% per year, but my savings account's only grown by 1% per year, I'm almost losing ground every single year. Now let me just pause for a moment and put that cost of college into perspective for you. So if the cost of college continues to rise like it has for the last 20 years at 6% per year, that means if I have a 2-year-old today and the cost of college today is $25,000 per year, by the time they reach 18, 1 year of college will cost $67,000 for 1 year, which means a 4-year degree will cost me over $250,000. Now people hear those numbers and say, there's no way they can let that happen. And I can tell you for a fact in the financial planning community, people were saying that 10 years, 15 years ago, there's no way it can keep going up. And it did. So it's almost like we have to prepare, like those costs are going to continue to increase. So you have to make sure you choose the right college savings strategy to hedge those costs. I hope this was helpful. If you have any questions on any of these college savings accounts, please feel free to reach out to us at moneysmartboard.com. Thank you.